Is there a place for specialist investment teams in South Africa? Are the asset sizes South African investors commit to these managers sufficient for a business case? And what about global clients? How easy is it to run a specialist investment team from South Africa? These are some of the burning questions we'll be answering tonight. So, gentlemen, once again, I welcome you to the program. And I think, Kokkie, let's kick off with you. Looking at the overall scenario that is playing out, and I have to congratulate you on a yearly basis. You and your team keep scooping many awards, so congratulations on that front. With regards to where we are right now, let's talk about what it means to actually be a specialist investment manager.
I think the main important thing being a specialist is you must be a specialist. So you build up knowledge on a specific sector. But the advantage of doing that globally is it's what we call geographically transferable. And, the important thing is that what happens in Italy today has happened in Argentina before and will happen in 20 years' time, most probably in India. And I mean, it's a simple example, but just having experienced certain things in certain countries allows you to learn from the previous experiences. And whereas in South Africa, you get a cycle once, let's say, every 30 years. Globally, you get that cycle repeated in many different countries. So essentially what we do, we've over the years built up a huge database. We cover about 400 financial companies globally, and simply rank them in terms of our calculated upside. Now, that overcomes your hometown bias or any other biases you have, because we simply focus on where our model shows the most upside is. And the important thing is obviously how good is the model. Yeah. And that's really experience, I suppose, for the last 20 years. I've been remodeling and reworking and backtesting, and indeed every year we first stand back and say, okay, what did the model predict last year, and how well did it do, and what did it get right and what did it miss, and we try and learn from those mistakes. Yeah. And so that's in a nutshell really what we do.
Okay, fantastic. Okay, so Cobie, and then over to you. I mean, how many types of specialist teams are there currently in South Africa?
Well, about a decade ago here in South Africa, we started having this kind of move into what we call specialist asset management skill. And I think the front runners of this, and I could be slightly off here in my calculations, but African Harvest, which is still going actually today, started what we call a silo approach to investing. And the silo approach to investing was quite simply taking teams and putting them into various silos for various investment expertise. And at that stage, they were defining different investment expertise around kind of value and growth and what we call core skills and so forth. Now, this is very, very different from kind of, for instance, what Kokkie is doing, where he's a global financial manager and he looks after financial type companies, and he follows financial type companies, globally. And I think that, that kind of set the scene. The silo approach set the scene for, kind of global skill to, get started here in South Africa. A decade ago, 2 decades ago, probably no global fund manager would have kind of run money from South Africa. Today, that certainly is the case. Maybe just a question for you, Kokkie, from me. I mean, how different is your process from running it from Cape Town, running global money? Is it any different from what maybe a global team would be doing, sitting, say, for instance, somewhere in the West?
I think we most probably differ on two aspects. One is we're a fairly small team, and because the funds we manage are still fairly small, so it's all effectively we sit almost in one room or in one. So your information transfer is quite quick and effective, whereas your larger global teams are often spread throughout the globe, and I think that defeats the objective of what I was saying earlier, in that your guy in Brazil doesn't get to speak to the guy in Hong Kong, and you don't get that transfer of information. So I think one transfer of information is quite effective. But I think, especially when I compare us to other smaller teams in other parts of the world that we compare, and mostly situated in, let's say, London or New York, then generally they tend to be very what we call index biased and always tend to look much more at the larger cap stocks. Whereas maybe that's our South African background, we've tended much more to look at emerging market banks. And I've been visiting emerging markets since 1995. I've gotten to know most of the banks there, and so I think that is one very big difference. It's very interesting. There was an article written recently comparing the top global financial funds, and one of the features was looking at what they call the commonality of the top 10 stocks, and they found a correlation between the higher the commonality, the poorer the performance of the fund. And what was interesting is that nobody else had our 10 stocks, so our top 10 stocks. So it means that we've been able to find companies that are literally mispriced, but that nobody else has been able to find. And so I think the second part where we differ from the other guys, once we've found the value, we basically get on the plane and go and visit. And so I think we travel a lot more than any of our competitors and basically go and kick the tires ourselves. And again, that is quite a long process because it takes years. It's not only the first visit, it's by the time you get to the fourth time and the fifth time that you really get to understand the issues. So it's the compounding of the knowledge that a lot of the stocks that did very well for us last year, we already started investing in 2004, 2005. So I think it's just that cumulative experience and the cumulative traveling and the effect of that sets us apart.
Okay, so I mean, just hearing the model that Kokkie has adopted over the last few years, it seems that it's really working well, and it's really evident in the returns that we've seen from a lot of his funds, but also his vision. When it comes to having a strategy, when it comes to global teams, we know that you have visited quite a few teams globally. What are the big differences, would you say, to South African teams adopting the strategy, an international strategy, relative to teams that are actually based on home turf, Roland?
Firstly, I have to congratulate Kokkie for achieving what he's done on the South African power grid, because his competitors don't have the kind of blackouts that he probably has to face as a fund manager. But I think what we see very much globally is this trend towards specialization. I think the challenge with specialization is not that there's anything wrong with specialization. I think the challenge is how do you put different specialist teams together. Now, this isn't the problem that Kokkie has, because he's just delivering on a specific mandate as best he can. So I think the challenge is integrating the different specialist teams into a holistic kind of portfolio construction process. But I think one of the opportunities that Kokkie has is that, as he mentioned, is that he doesn't get the group influence. In other words, he doesn't have a house view that he has to sort of fall in line with, which I think a lot of the global teams have to do. So there's a global economist who says the currency, whichever currency they're looking at, or countries, they make forecasts, and everyone has to sort of adopt those forecasts, and it sort of dilutes all the specialist kind of skills that you find in these teams. So I think Kokkie doesn't have that, but I'd like to ask him about how he actually would address something like the lack of, do you do your economic modeling yourself, your sort of top-down kind of stuff, or do you rely on other people's forecasts? Because obviously you don't want to be influenced too much by external forces on that front.
No, Roland, you touched on quite a few very important points there. But starting with the last one, we tend to be very bottom-up and value biased. So where's, as you know, even being bottom-up, your forecasts are important. So in terms of that, we're always aware, once we've found value, of what the macro situation is, but we never start top-down, which if you have a strategist or economist leading a group, that would force you to say, okay guys, India's growth is the highest, let's go and find stocks in India. We start the other way around and say, where at the moment are stocks most mispriced in the world? And then go and look at those companies and find, okay, why are they mispriced, and will those factors change, and will that valuation unlock? So you're right there. We're totally not top-down driven, and if we had, in fact, I never actually speak to the Sanlam or Sanlam Investment Management economists or strategists. We try and be unbiased on that regard. What is interesting is, as you said, regarding the investors, we have two types of investors. We find that, let's say in the UK and Europe, the investors are more what you would call the multi-funds or platforms, who allocate a certain percentage of their investment to special categories. Now, one of them would then be financial. So they say, okay, I want 5% of my funds in financials, and I'll then go and find the best financials manager. Whereas in South Africa, we find generally it's more private clients or high net worth individuals who identify with the style. We say, I recognize that being a specialist in one category is most probably an easier way to make money than to be a generalist of many categories and be diversified. So they take a risk, but normally through their advisor you find in the end it's also, let's say, 10% of their assets, but they haven't maybe given it to financials. They've just decided they'd like to follow the specialist approach and they want a specialist to manage it. I just happen to be in financials. If I was a tech specialist, maybe they would have given it to me as well. But there they just say a specialist generally should do better for you, but there is a higher risk of being in one category, and like in 2008 where financials totally tanked and we went down with financials.
Kokkie, maybe just a question, from my perspective. You spoke just now about how you started following many of these kind of mid-cap and small-cap banks already back in 2004 and 2003, and how many of those have actually contributed significantly to returns during the 2010 season. Now, is it not interesting that in the meantime, though, you got to put kind of assets in the fund and you got to make sure this thing works? Now, you make the point that internationally you've got multi-fund type or multi-manager approaches that dedicate a portion of assets to you, but in South Africa it's more private clients. Who looks after these clients? Who does the servicing of these clients? It must be really, really busy trying to analyze stocks and at the same time trying to also make sure there's enough assets in the fund. Probably easier today that Investment Week's Fund Manager of the Year award winner, but maybe very, very difficult maybe 7, 8 or 9 years ago.
Now we started the fund actually 11 years ago with $5 million, and it's now about $250 million. And those first years, as you say, were very difficult because the objective is always when you run a fund to try and be profitable, so you haven't got that pressure of having to seek performance. But client servicing is vital. And I think a challenge as well in South Africa is where I think technology has made it easier and possible to manage funds from anywhere in the world. It is true that if you are in London or New York, let's say as two examples, of Hong Kong, the availability of experienced people they are much more available. So one thing in South Africa, we tend to have to train people, which sometimes is an advantage because they just get to learn to do it my way. So we never have an argument on investment style. But one of the people that really came through the ranks for me and now heads up our client communication is Nora Geldenhuys. And she does an unbelievable job, but you're quite right. It takes a lot of effort to keep communicating to clients and why we're doing things, what we're doing. And actually 2008 was fascinating. We had almost no outflows, despite the fund being down about 60%, 60, which, as you know, that's massive. But because we kept communicating to clients what we were doing, why we think the markets are wrong and that it will come back, and indeed the fund in 2009 went back up 90%. So that communication was vital.
Kokkie, a little earlier you said that you always review the model, you take a look at the successes and the failures and see what goes wrong and what goes right. Take us through some of the most pertinent things that have changed the model over the past few years, and I'm alluding to the economic recession because that really shook things up, especially in the financial industry.
No, that's a brilliant question because it reflects the financial world has changed dramatically, whereas the factors we used to look at a lot were, let's say, obviously loan growth and return on capital. But to a certain extent, we used to ignore liquidity on the bank's balance sheets and also gearing. Generally, one advantage of banking is because it's all regulated, the gearing does tend to be within certain parameters. But the 2008 crisis showed that the less liquid the balance sheet or the shorter the maturity of your deposit base, and also in terms of your gearing, less gearing was better. And whereas in 2003, 4, 5, in the golden years and before that as well, gearing and liquidity didn't matter. And in fact, it wasn't even prominent in the models. It was always the data was there, but we didn't really actively concentrate on that. And now it's one of the first things we look at, the gearing, and much more on the return on assets versus the return on capital.
Kokkie, did you see the recession coming? Did you even anticipate such a dramatic fall across the board where we saw a massive crisis playing out? Did it cross your mind?
Did we foresee the extent of what happened? No. It was amazing how the whole thing unraveled.
Yeah.
But, we did foresee that something was going wrong. And in fact, that hurt us as well, because we remain invested in a lot of the Indian and Indonesian banks that were very undervalued. But the one thing in 2008 was when the global liquidity crisis struck, everything was sold down. Whether you were in Indonesia, whether you were in Brazil, there was almost no stock that was spared. But what was very important is that our Indonesian and Indian stocks, in terms of their results, almost like the South African banks, were not really affected. So once the crisis was over and liquidity came back, those stocks bounced quite back because there was no value destruction, whereas companies like, let's say, AIG or Barclays or Citigroup had destroyed half their capital and didn't bounce back. So we benefited after the crisis from that, but not during the crisis.